All right. Thanks for joining us today. Welcome back to Lunch of the Market. Today has been one heck of a busy day. We're sifting through all of the names that are on the red list today, right? Anything that's going down for last minute spreads before we hit OPEX next week. Next week, Theta will really step up its dirty work and decay the prices of those options, which, of course, if you're short, is fantastic. As we get into next week, out of the money options are going to be worth less and less and less as it becomes less possible that they'll become in the money options, right? The goal, obviously, when you're short spreads is to get them to go to zero, at which point you're completely profitable and you're happy. All right. We have started to clean up our book and buybacks the short side on things like the F5 195 short put spreads and the Apple 220 215 short put spreads. With F5, there's really no bid at all for the 95s because they're just so far out of the money right now. But you can buy back that 100. Don't try not to take the offer. There is no bid, and then the offer is 10 cents. So we actually bought back those 100 short puts for 5 cents. So we basically closed down that side of the spread. We took our risk off the table. Now it doesn't matter what F5 does. Heck, if it plummeted, because we still have the 95 puts on there, it could be a double whammy. We don't see that happening, but it's, we have it if we need it. And then you can use some of that capital to either pad your cash position or to relay out those last minute spreads. So that's what we've done, is lay out some of those last minute spreads, right? You can accept a worse risk reward, because you're just so far out of the money that it doesn't look like it's going to happen. Call those gimmies. But take a look around at the positions that you follow, and if something's in the red today and you can get a really decent price for something that's down and out, say $10 away, go ahead and sell those and then manage that trade into expiration. I wouldn't make it the normal position size, just because you're really trying to juice returns by doing that. So take a look at buying back some of those spreads that you're short, especially if you're in the 90th percentile. Apple, we bought back the whole spread for 5 cents, the 220, 215 put spreads that we sold. And there was just no reason to not to take those off the table. So cheap to buy them back. So if for under 10 cents, if you can take off a short put spread at this point in the trade, go ahead and do it and look for last minute opportunities. Don't be greedy. All right. The other thing that we did is called a cashless collar. So Weatherford, symbol WFT, we're up pretty big, better than 30% rate of return on, say, 6 months or so. It's been a great stock. It's just ripped higher. It looked pretty terrible there about 6 months ago, and we just really, really loaded up on the position, and we're up significantly from there. So we're putting on what's called the cashless collar. So you have a long stock, and you sell an upside call and use part or all or whatever you need of the premium to go finance the purchase of a downside put. In this case, the stock's trading just under 25. We sold the 25 call, and then we used the proceeds to buy the 24 put. So there's only about 80 cents worth of downside. There's only about 15 cents worth of upside. If it gets above 25, boom, we get called away. If it gets material above 25, we would consider rolling that 25 up and out, right, to continue on with the trade. If it finishes, say, 10, 15 cents above $25 a share, there's really no reason not to get called away. For our cashless collar, we actually got paid between 25 to 30 cents just to put the position on. So we're instantly profitable. We already hold the stock long. So either scenario, we're okay, right? The max loss, I guess you could say, we took in 30 cents. So the max loss would be 50 cents, right, between where the stock trades right now and that 24 put where we're protected. If it falls below 24, we can exercise the put, still be rid of the stock. We're up huge, so it's okay to give back the little gain. But the moral of the story on this trade, on the cashless collar, is to do it in a way that you become market agnostic, right? It really doesn't matter what the stock does, because you're going to get called away if the stock continues higher. You have the option to roll that out or out and up. Depends on how long you want to be in the trade. Heck, if the stock trends around 25 for months and months, you might as well keep rolling it out and rolling it out and rolling it out, right? You take in, if you can take in 30 cents every single expiration, by the end of the year, you've made an extra, $350. You've had the position the whole time, and you've been protected on the downside the whole time. So it's really not a bad way to go. Again, it's called the cashless collar. Sometimes we put on low-cost collars, meaning there's just so much premium to buy that downside put that we do have to pay a little bit of it, but it's better to be hedged. Cisco, right, was a good opportunity where we should have had a collar on it. We went in to earnings with a short call against our long stock, right? So long stock, short call, but the problem is the downside is all the way to zero if you just long a covered call. And then, of course, Cisco got blasted and traded down to 17, 18 bucks, wherever. I haven't looked at Cisco in months now, but it was an ugly trade, and we really should have spent some of the profits from the call that we sold to buy puts below it. So again, it's called the cashless collar. You sell a call against your long stock, you use the proceeds or part of the proceeds to buy a long put. Short, long, long. Okay? So hopefully everybody understands that structure. If you have questions, just put in a comment section on the YouTube channel or mention us on Twitter. Hope @JZZ enjoyed yesterday's episode. They had written in a bunch of questions on our YouTube channel. We answered those yesterday on exactly how we put trades together. Okay, some of the other names that we took profits in are our rare earth names. AVL, that is a wild ride to be sure. When the stock cratered just above $5, I think we really loaded the boat. We doubled down on our position. Now that we're better than 17% profit, we're starting to take some of that off. So AVL, we've started to sell out of those. Also, we're up about 60% or so on our Molycorp, symbol MCP, long March 50, 55 call spreads. Now the stock is just, it's trading around 51, 52, it fluctuates around there. So we're nowhere near the full $5 spread. And with February's expiration coming up and we haven't seen a pullback in the market, we just felt better if we could start scaling back in those. We had a really good sized position in that Molycorp long call spread. So we're going to start taking those off once we get better than 50%, which we saw. So we're taking some of those off. That way we can be opportunistic. If it pulls back, we'd probably consider re-adding to those because the fundamental story on rare earths, meaning they go into almost every electronic device and they're seen as strategic assets for governments of countries around the world, we like being in those longer term. We'll probably have a position in the rare earths some way, some form, some shape for quite some time. But for now, it's been a great run. We're going to take some of those off the table. Okay, if you didn't take the opportunity to hedge, right, we've been really talking about hedging a lot lately, protection, VIX call spreads. If you haven't bought any long VIX call spreads or long S&P 500 put spreads, that's the SPX. Again, you can type in VIX, or on the right-hand side, on Trade Monster, or on the right-hand side, you've got your indexes. You can just click on the S&P. Then when you're viewing a chart, you can click the options, and you can get those options right on the S&P 500 index, not the SPY, which is that ETF, but the actual S&P 500 index, and they're settled cash, right? They're settled in cash. That's how they do those. Okay, so make sure that you're hedged. Take some things off the table. A lot of stuff is run. Energy's really run, which is why we're putting on the no-cost collar, the cashless collar on Weatherford, WFT. The metals have really run, which is why we're taking down some of our exposure in the rare earths. And we haven't seen the market sell off in quite some time. We did see those high beta, high flyer names like Deckers, Lulu, Amazon, Netflix get rocked for about 5 to 10%. Certainly F5 hit that category. That was a correction that was pretty hard and fast that lasted probably about 5 days worth of selling in those names. And then there was the nasty day where the Dow got blasted for about 200 points to the downside. So the pullbacks are quick and they're sharp. So you have to have your protection in place. If you start putting on protection in the first day of trouble, there's a good chance that you're just throwing your money away, and that really the explosion of the VIX happens all in one day. You get a move in the VIX from 16 or 17 all the way to 21, 22, and at that point you've got to be taking your hedges off. So put those in on a nice sunny day when the market is drifting upwards, not on a day where it looks like the rain clouds are rolling in. Okay, because at that point you really can't tell whether or not it's going to last for some time and it's just going to rain and rain and rain, or whether it's going to be boom, one day, nasty, done, shake a bunch of people out, and then keep rolling. All right, buy insurance on the house before it catches on fire. Thanks for joining us again today. Our hedges are in May. Just keep that in mind. We're trying to protect ourselves against sell in May and go away. Thanks for tuning in again today. Have a great day, and we will see you tomorrow. Don't forget to check out America's Favorite Traders on iTunes by searching for Magnum Opus Financial.